runner, a sprinter. If you're running really, really, really fast, you're gonna take some break. So what you see here, it run really fast, and then take a break, go sideways, try to decide what to do, and then bam, you start running again, and then reverse and go back again, and then now it's taking the breather. Just think about it as an athlete. Whenever you see price keep going up like this, resist the urge to chase it. Which is why I always say do not chase price, because that's usually the signature. What you usually do is have a quick run up, and you psychologically you're thinking, okay, this is an opportunity for me to get in and participate on the action before it's too late. And next thing you know, you get burned or it reverse on you. And in this case, for that 1 hour, for that 10 o'clock 1 hour Fibonacci, I say all the bodies remain below the 50%. To me, that signals to me there's a high probability that it will go lower. Doesn't mean it will, but it kind of give you a roadmap. It kind of give you an indication what price is trying to do. And we have our first fair value gap after 9:30 a.m. at the open, and we'll see all the candles remaining inside of that gap right here, which also could lead to problematic issues, right? Because whenever you see pricing inside of an efficiency like this or a gap, I call it inefficiency, a gap, fair value gap. When it's staying inside of a gap like this, it's usually problematic. That means price is going to become very difficult, and so far as you can see, it's been very difficult. What you usually want to see is price to come in, make a quick wick, like one of those wick that you see here, a quick inside of an inefficiency or inside of a gap, and then quickly trade in the direction that you want it to be. When it's spending that much time inside of a gap, it will probably be best to just close the trade. When you have all of this back and forth inside of a gap like this, it's usually problematic, and like 7 times out of 10 is gonna go against you. Seven, like if it goes all the way up and stop me out, I would not be surprised. It will usually go in the opposite direction of what you intend. This is why sometimes I can tell what price is going to do. Like, look at it. It's a lot of wick. It's a lot of back and forth. If you don't know what you're doing, you're gonna be hesitant. You'll probably reverse and you'll probably try to chase it. It's not worth it. It's best that you stay out. How do you best trade it to know exactly what it's going to do? The best thing you need to do is whenever it trade out of it and then come back. Let's say, for example, it needs to go lower. It needs to trade out of it lower and then wait for it to come back. Or that next candle that's outside of it, the full body that is outside of it, and then you wait to trade below that half, and then that's when you'll be able to get in. So let me candle coming outside of that gap here. As you can see, this big gap right there is a big gap. Whatever candle is submergedly way outside of it, you can go ahead and take a short. And I mean, just rewind the live stream whenever you get a chance. Rewind the live stream, and I'll show you there's gonna be a box, a big candle here, and then the moment the big candle box come out, and then price is gonna go lower, come back into it, which is right here, and it comes back to it again right here, and you have to take your trade below the 50% of that gap, and it come real close to it right here, right at it. So you got 2 attempts to go short right here, and it's based on that candle. That candle is very significant because that is the candle. It's just like coming out of the water, right? And it's completely submerged outside, either into the water or completely outside. So that candle and that candle at 1027, these two candles are very significant. It's significant because that's the first candle completely outside of that range, outside of that gap. But also, this candle is showing willingness for price to stay outside of that range, to finally coming outside. The opposite could have happened. It could have happened on top here, but now it just sort of happened to that it happens at the bottom. And I was able to take a partial here. If price doesn't get into the deep discount, that means price is really bullish. That means they're really trying to push it up, meaning there's a level they're trying to meet before they push it down lower. So they're not even gonna bother to push price lower. So if they're not gonna bother to push price lower here, that means they're extremely bullish. That means they want to push this up as much as possible. Just because I have a theory or I have a sentiment, just because it didn't happen doesn't mean it fails. It just proves the other theory. Because as you can see, price can either go up or down. If it fails to go lower, that means it's gonna go significantly higher. Even the Fibonacci's, there are nothing magical about them. I mean, again, like I said, it's a roadmap. Just take a look at your core. You have a speedometer. There's nothing spectacular about the speedometer. Yes, it can prevent you from getting a ticket. It's gonna prevent you from crashing your car. But there's nothing magical about the speedometer in your car. Same thing. Same thing for the Fibonacci. Same thing for all this market structure there. It can break through it. It can go right past through it. With all these manual interventions, especially right here, it can go just straight through it. The only thing you can do and can control is yourself. Not put in a whole lot of trade. Do not chase price. Like when it comes really high like this, trying to chase price. And do not over leverage. And then do not over trade. The only thing you can do is to protect yourself. Protect your mental capability, protect your capital gain, protect your mental capital. Don't think too much through it. Just take a trade, run it, see how it works, and wash, rinse, and repeat. And then find favorable conditions for you to trade. What are the favorable conditions? The wick inside of the gap. But this is no bueno. I mean, just like I mentioned earlier, any action, any lots of candle you see inside of a gap is problematic. Yeah, the gap is all over there, but that gap affects everything that goes on the right hand side. Okay, so when you see all this action inside of that gap, it's problematic. I mean, if you don't have the mental fortitude to stick with it, it's gonna you're always gonna second guess yourself. You're gonna reverse. You're probably gonna make a bad trade. You're gonna overtrade, and it's gonna frustrate you. So yes, that gap here is affecting everything else that's happening over there. That one right there. Just because there's another candle that go right through it or around it doesn't mean this one is not affecting this one. This gap right here is affecting everything else going on the right hand side. Why? Because that gap formed after 9:30 a.m. Also, that gap is the gap that break the camel's back. Any of the traders who had the stop loss here, take out the stop loss. So that's why that gap is significant. And that's why you're seeing all this price action here. Even though it was a manual intervention, but they did it inside of that range.